everyone, I'm Gloria. Welcome to my accounting assessment. This is a balance sheet and an income statement. On the left is the income statement, stating the revenue and expenses. In the income statement, to get the net income, simply subtract total expenses from the total revenue. On the right is the balance sheet. Basically, it's a snapshot of the financial position of the business at any given point in time. In the balance sheet, there should be a title consisting the name of the company, balance sheet, and the date. We also put the assets on the left and liabilities on the right, and equity on the bottom. Much like the income statement, the balance sheet contains summary totals. For example, business may have 3 bank accounts, but only one line item on the balance sheet for a cash in the bank. The total from all 3 bank accounts are pulled from the general ledger and combined to come up with a summary total. This is much the same for every line on the balance sheet, even owner's equity. The relationship between net income and equity is when net income increases, equity increases too. Net income belongs to owner's equity. Therefore, it is also included in the balance sheet. Also, when revenues increases, assets and equity increase. However, when expense increases, assets decreases and or liabilities increases, which equity will decrease. The difference between income statement and balance sheet are for investors, lenders, and business owners. The balance sheet will show you current assets, liabilities, and equity or capital. However, most finance people will also want to explore the income statement to see how well one's company's sales are covering its expenses, determine net profits or losses. Therefore, both these financial reports are usually necessary to gain a clear understanding of the state of one's business. Net profit is a measure of the profitability of a venture after accounting for all costs. The final representation of how much money a company has earned from doing business over the course of a year. It is calculated by taking revenues and adjusted for the cost of doing business, depreciation, interest, taxes, and other expenses. This figure is found on the company's income statement, and it plays a crucial role measuring of how profitable the company is over a period of time. Net income is calculated by starting with the company's total revenue. From this, the cost of sales along with other expenses is removed to reach earnings before tax. Tax is deducted from this amount to reach the net income figure. For example, suppose that your gross income is $50,000 and you have $20,000 in deduction in credits. This leaves you with taxable income of $30,000. Then suppose that another $5,000 of income tax is subtracted. The remaining $25,000 will be your net income. Business entity concept is the idea that a corporation should be considered to be an individual entity separate from the individuals who make up the corporation or those who finance it. In other words, it means that for the purposes of accounting, the business and its owners are to be treated as 2 separate entities. For example, if you start a new business and invest $10,000, then it is treated as liability from the point of view of the business. In the same way, suppose your business is of manufacturing pens, and you take 10 pens, then it is treated as drawing by you, and relevant entries will be recorded in the banks of accounts. Assets, liabilities, and equity are the 3 components that make up of a company's balance sheet. The balance sheet, which shows a business financial condition at any point. Assets are anything tangible or intangible that are capable of being owned or controlled to produce value, which have positive income value. Liabilities are those amounts owed by a business at any one point. It is often expressed as payables, including loans, mortgages, account payable, etc. Where equity is called capital, any debt owed to the business owners. Total assets is always equal to the combined liabilities and owner's equity. This is known as the accounting equation. This equation is a framework for keeping track of money as it flows in and out of a company. The following total states the transactions for Mr. G. Lee's account, Mr. G. Lee's garage. I use a journal entry to record the accounting entries for all transactions. The transactions are recorded in the order of their occurrence. First, I put the month, date, and year on the first column. For the first transaction, I debit accounts receivable D. Kim $3,000 and credit fees earned $3,000. The credited account and amount are recorded second and are indented. The third row states the description of the account. Performed service on account. Then skip one line between transactions. The second transaction, put down the date only on the first column. Debit cash $1,000 and credit accounts payable C Huang $1,000. Received cash on account. The third transaction is March 10th. Debit card expense $8,000 and credit cash and accounts Gloria accounts payable Gloria's Auto each $4,000. Expense on card and cash on account. The last transaction, debit $2,000 cash and debit G. Lee drawings $2,000. Credit revenue and bank each $2,000. Performed service for cash and withdrew money for personal use. In this journal entry, the first transaction missing the description. It should be cash on account. Also, in the second transaction, the description should be service performed on account. Third one, expenses on advertising. And the last one is sold truck. There are errors in this journal entry. First transaction, as revenue should be credited since there is an increase in equity resulting from the service in the business. For the second transaction, it should be debit G. Lee drawings $500 and credit bank $500. The decrease in equity is not an expense and must be charged to the owner. The drawings account is also affected when the owners withdrew money for personal use, but has the business pay for it. In any event, when recording the transaction, the debit must be to drawings. G. Lee withdrew $5,000 from the business. Unfortunately, he only wanted to withdraw $500. In order to fix this transaction, debit G. Lee drawings $5,000, credit $500 from bank, and credit $5,500, $405,000 from his drawings. Withdrew money for personal use. This is a trial balance. It is an accounting listing that shows the beginning and ending balances for all accounts. It makes it possible to evaluate whether or not the total debits for the periods cited are in balance with the total number of credits generated for the same period. When the true trial balance exists, the total credits and the total debits will be equal. It is prepared to balance after all the transactions for the period have been journalized and posted to the general ledger. The format of this is a two-column schedule, with all the debit balances listed in one column and all the credit balances listed in another. It is important to note that just because the trial balance balances does not mean that the accounts are correct or that mistakes did not occur. There might have been transactions missed or items entered in the wrong account. For example, increasing the wrong asset account when the purchase is made for the wrong expense account when a payment is made. The following table states the account in the financial statement for Mr. Lee's garage for the month of May. I created an income statement based on the previous table. The heading name of the business, which is Mr. Lee's garage, income statement, and accounting period for which the figures have been accumulated. The revenue sections shows an increase in equity resulting from the proceeds of the sale of goods or services in the ordinary course of business. Two types of revenues are shown in the statement: service and parts revenue. The expenses section shows decreases in equity resulting from the cost of the goods or services used to produce the revenue. The net income figure is the difference between the total revenue, which is $35,000, and the total expenses, $9,631. If the revenue are greater than the expense, in this case, the net income is $25,000 and $369 in results. Assume that each of the two companies have been forced out of business and must sell its assets for cash in order to pay its debts. In Jolie's salon, the values shown are not necessarily the values I could get. Bank is only $700. However, account receivable is $59,500. In Gavin's Cantonese school, there aren't any problems associated with selling the assets. Since if you still have money to pay its debts, if you subtract total assets, $95,500 by the sum of accounts payable, $22,800, and mortgage payable, $22,000. Gavin's company would be better to own. The ratio of assets and liabilities and equity of it is smaller than Jolie's salon. Rather, Jolie's salon has a higher ratio. The amount of liabilities and equity figure is relatively high for Jolie's salon. Therefore, they had to pay back more money than Gavin's Cantonese school. On the other hand, Gavin's Cantonese school has a lower risk of not being able to sell its assets. Therefore, Gavin's Cantonese school is better to own. This is the end of the Vodcast. I hope you enjoyed it. Thank you.